Okay, today we're going to talk about how to use candlesticks to confirm trading decisions. But first, what is technical trading? If you've already started trading, you'll know the feeling of sitting staring at the market, wondering which way it's going to move. And as share prices tick up and down, picking the right move at the right time can be the difference between making or losing thousands of rand. If you're looking to avoid the fear and indecision that comes with the market, technical analysis could be your answer. This quick tutorial will reveal 6 patterns that could easily save you 20 grand. So how does it work? Technical analysis applies historical price action to help you make buy and sell decisions. Most technical analysis is done using charts, which make trends and patterns easier to see. Consequently, technical analysts are sometimes called chartists. It's a very different approach from fundamental analysis. Chartists assume that markets and prices are related to the psychology of the market participants, more than the factors such as health and management of the relevant economy, sector, or firm. So when does it work? Fundamentalists often scorn technical analysis on the ground that past price movements cannot predict what a share will do in the future. No chart will ever tell you that Trevor Manuel is about to resign. Black swan events, as they're sometimes called, cannot be predicted with technical analysis. In fact, technical analysis won't even help you predict how well executives are running a company. But where it is exceptionally good is with short-term timing, which is especially useful for geared traders. So why is it useful for geared traders? The truth is, between results presentations and trade updates are long periods of time where there's supposedly no relevant price news. Of course, shares will tick up and down depending on where the currency moves and the costs related to the input factors, but these numbers simply give an investor a rough idea of where stock should be trading. In the end, the share's price is driven by investor sentiment. And when it comes to telling how investors are feeling hour to hour, day to day, and week to week, the typical time horizon of a geared trade, technical analysis is very good. Momentum indicators and oscillators, while valuable in fluctuating markets, often become useless in strong bull trends. They continually throw out overbought signals even though you'd have closed your trade successfully long before a pullback came. So today I'm going to skip the basics, moving averages, RSIs, stochastics, MACDs, and instead get straight to the fun stuff. I'm going to show you 6 short-term candlestick patterns that you can use immediately as an extra confirmation that you've made the right trading decision. But first, how does a candlestick graph actually work? Here's an example of a candlestick graph. It's going to give you all the same information as an open, high, low, close graph, but sometimes it's easier to read at a glance. At the top, you've got the high price of the day. Over there, at the top of the real body, you've got the opening price in the case of a red candlestick. It would be the closing price in the case of a green candlestick. The center section, also called the real body, is red if the close is lower than the open, and then green if the open is below the close. Here in the case of the red graph, we've got the closing price, and at the tip of the bottom wick, you've got the lowest price or the low shadow, the low of the day. Okay, now we're ready to move on to some patterns. Okay, the first candlestick that you need to know is the hammer. This is a bullish signal if it occurs after a significant downtrend. A hammer is identified by a small real body, i.e. the small range between the open and closing price, and a long lower shadow. The low is significantly lower than the open, high, and close. The body can be red or green, that doesn't matter, and this signals that you should buy. The second candlestick is the hanging man. It's the same as the hammer, but happens after a long uptrend and has the opposite meaning. They are identified by small real bodies, small range between open and closing prices, and again the long lower shadow. Again, the bodies can be red or green, but the hanging man signals sell. The third candlestick we're going to look at is the gravestone doji. This line signifies a turning point, either bullish or bearish depending on the trend that comes before. It occurs when the open, close, and low are the same, and the high is significantly higher than the open, low, and closing prices. If the gravestone doji comes after a series of lower lows and lower highs, a downtrend, it's time to buy. The next candlestick pattern you need to know is the doji star. It's very similar to the gravestone doji. All dojis represent indecision in the market, but the star will be your signal that a reversal is on the way. If this comes after a rising bull trend, then it's time to sell. The fifth candlestick pattern you need to look out for is the dark cloud cover. The first line is the long green line, and the second is a long red line. The second candle opens higher than the first. It's more significant if the second body is below the center of the previous one, as in the picture. If you see a dark cloud cover, it's time to sell. The last candlestick pattern you look out for is the harami. The harami means pregnant in English and indicates a decrease in momentum. It happens when the day's body can fit entirely within the body of the day before. If this happens after a bull trend, it signals that it's time to sell. I hope that helps you with your trading. If you have any questions or comments, please feel free to give me a call on 011-451-0206 or drop me an email at gary@absolutealpha.co.za. And remember, if you do open your account with us, as a Fleet Street subscriber, you're going to get your first trade free.